Mike Tedeschi, Portfolio Manager over at Perspective Wealth Planning. In this video, we're going to take a look at the four major U.S. indexes and talk about the fact that we finally have ourselves a green week after 7 straight weeks down on the S&P 500, 8 straight weeks down on the Dow. It looks like we're finally putting in that green candle. But what does that mean for us moving forward? Are we out of the woods just yet? Let's take a look at some key levels and talk about what's going on here. So we're going to start with the S&P 500. The first thing I want to do is I would like to put the 200-day moving average on the chart. All right, that is this purple line that we have right here, and what we have is a declining 200-day moving average, meaning the average price of the market is falling if you average the last 200 trading sessions, right? When we have a declining 200-day moving average, that is when bad things happen. That is your 2020 coronavirus move, and then from there, we had a rising 200-day moving average until here. All right, and that move in April, we've seen that big fall off on the overall market. Now, the 200-day moving average is what the financial news media really likes to use in terms of, oh, we're under the 200-day moving average, that means bad things. Oh, we're above the 200-day moving average, that means good things. It is an important level, and the reason why it's an important level is because so many people watch it. There are a lot of decisions that get made above and below the 200-day moving average. And if you go back in time, you can see a lot, and I'm going to show you a couple really, really good examples. Right, the 200-day moving average acts as support here in 2016 multiple times. It does it again in 2018. Right, that's where we have a lot of price action in 2019. We continued to move forward when we had that big V off of the bottom in 2020. The 200-day moving average is right where we kind of had that price action. So it can act as a very important level, and the reason again is because so many orders end up being at that 200-day moving average. Now, when we have a declining 200-day moving average as time goes on, this moving average is going to continue to come down, and it's going to act as a potential area of resistance, again, because so many people watch it. If we go a couple of weeks out into the future, what this chart is going to look like, we're going to come down on that moving average, and we're going to be right around that 4,300 level. And when we're at that 4,300 level, there's that major resistance zone from April where we were not able to get above, and we're going to have that 200-day moving average there. That 4,300 zone is going to be a major battleground here over the next couple of weeks, and this is an area where we really should pay close attention to, because if we are in a consistent bear market, we are going to end up with lower highs if we fail there, and we would have lower lows in place. That's a clearly defined downtrend. Now, on the flip side, if we run into this zone and the market is able to get back up above that zone, 4,500 or the 450 on SPY is going to be that major level that we're going to pay attention to there, because if we got up above that, we would then have taken out a couple of previous shorter term highs and can start to kind of work off that potential lower highs and lower lows that we currently have. So there is a lot of interesting zones to pay attention to, but before we get back up here, the area we really have to pay attention to is 4,100. We've talked about 4,100 a lot. That is this price action zone from 2020. That's where we got our bounce in February. That's where we ultimately got our breakdown from. And we're trading just below that 410 level, that 4,100 level. On this chart, if we zoom in on an hourly basis, which I want to take a look at next, you can see the importance of this price action zone that we're in right here. This is a big, big, big battleground. And looks like we're going to close the week somewhere near this zone. So if I turn this now into weekly candles, I'm going to take that 200-day moving average off of the chart so that we don't see that anymore. And I'm going to bring this into the weekly view. Right? You can clearly see the importance on a weekly chart of this zone. There has been a lot of price action in this area. And right now, all we are doing, as good as this week has felt, is testing the underside of what was support before, and typically that can tend now to act as resistance. So a failure here would not be what the bulls want to see. We have a huge battleground playing out right here. It's really important to pay attention to what goes on at this juncture. Let's take a look at the other three indexes from that same light. Now the NASDAQ, right? There is a major level right here I'm looking at QQQ in today's video. Right at that 320 level is the major level of support from before that broke that can now act as that resistance zone. All right, we've had a bounce. We have a couple of big green days, but we have not gotten back above this zone. We still have a series of lower highs and lower lows in place. Now, this rally this week has felt different than some of the other rallies that we've had this year in terms of it feels like there could be some sustainment to it simply because the sentiment out there has been so horrific. And again, we had 7 red weeks in a row on the S&P 500 and 8 on the Dow. If you take a look at the Dow, the last time we had 8 red weeks in a row was 1923, right? So it seemed like things might have gotten a little long in the tooth in one direction. But when we look at the Dow right now, we're also at that major important resistance zone. What was support from before was now could potentially be that resistance zone. All right, we've had a nice bounce here, but all we've done is run right back up into a major price action zone. We need to see things get above these zones here next week. We need to see that follow through, and we need to get back up over that 340 on DIA. Now, last but not least, we'll take a look at the Russell. Now, the Russell moved all the way back down to that 2020 breakout zone. So it gave the entire move back. It's the first index to do that. It held. And what's very interesting with the Russell, I'm going to look at this on a weekly time frame now, guys. Right? We actually put in a higher low last week. And you can see that. It's the only index to do that. Everyone else made a lower low last week. And now it's starting to push itself back up. The thing is, on this chart, we're looking at a resistance zone right around that 190 area, and we're still below it. And this also has clearly been a leadership to the downside. It actually topped sooner than all of the rest of the indexes, still in that downtrend. So what happens right here is really, really important as well. And as we've always talked about, the Russell can be kind of that canary in the coal mine leadership because it is a good gauge of risk on or risk off behavior. And so we're going to pay very close attention to what happens right there at that 190 zone. Bottom line, guys, we had a nice rally here this week. It felt good to have that relief from that selling pressure that has been in place here over the last 2 months. But we are nowhere out of the woods yet. We still have to pay very close attention to what is going on. We can't signal the all clear because the bottom line, a downtrend is defined as a series of lower highs and lower lows. And we still have a series of lower highs and lower lows at this point. We've got to make a higher high in order to negate that downtrend, and we are at some very key levels across the board. So we're going to pay very close attention to what happens next week. As always, if you guys have any questions, feel free to reach out to me at mtedeschi@Perspective Wealth Planning, or you can give me a call at 814-580-9881. I hope you guys have yourselves a fantastic weekend. I'll see you next week. Take care.